The US financial system is like a ticking time bomb. Debt is piling up, wages are low, and people keep losing their jobs. But we've still got something to rely on. If you want to know what that is and what Raoul Pal thinks about the US dollar, the housing market, and the upcoming recession, make sure to like and subscribe to the channel for more. Now, let's get started. Alright, let's dive into this talk about the US financial system. It's like a volcano ready to explode. We're pretty sure it's going to erupt eventually, it's just a matter of when. Maybe in 5, 50, or even 100 years, who knows? But it's going to be a big mess when it happens. Now, back in 2008, the global financial scene went haywire. Since then, it's all been about managing the crazy amounts of debt floating around. There were two ways this could have gone down. First, without big government interventions like quantitative easing, we might have seen an Argentina-style collapse. You know, where everything goes down the drain? But instead, we chose a different path. We're on a glide path. We're gliding along, hoping we don't crash. It's like when you're in a plane and it's coming in for a landing. You glide for a while, but eventually you hit the ground. It's just a slower crash, so we've been buying time. Our big problem is that if you're drowning in debt and your income isn't growing, it's like trying to swim with weights tied to your ankles. So what have we been doing? We've been basically using one credit card to pay off another. That's not a long-term solution, but we're crossing our fingers that somehow, someday, our income will pick up. You might be wondering, when was the last time real wages went up? Well, it's been a long time. Think back to around 1972, and that's when things kind of froze on that front. The dream of working hard and getting richer didn't pan out as planned. And it doesn't look like investing in the stock market is as perfect as it seems either. So the stock market rises and falls in response to the amount of money being pumped into it. When more cash flows in, asset prices surge because they become scarcer in relation to the available money. But as prices rise, it sets off a cycle, creating both booms and busts. Enter Bitcoin. Bitcoin works differently. Its value rises because people turn to it when they're concerned about traditional currencies losing value due to inflation. When more money is printed, the cash you hold becomes less valuable. Prices go up and your money doesn't stretch as far. Bitcoin offers a solution because there will only ever be 21 million Bitcoins, making it immune to printing of more money. People invest in Bitcoin to shield their wealth from this value erosion. The key to Bitcoin is to buy it and hold it. Despite the roller coaster-like price fluctuations, each low tends to be higher than the previous one. This pattern indicates an upward trend. So, use the down cycles to accumulate more Bitcoin, because they often precede economic slowdowns and the injection of more money into the system. Understanding the difference between cyclical trends and secular trends is crucial. Bitcoin falls into the second category, representing a long-term response to issues in the financial system. Over time, more people recognize its value, and its price generally goes up. As for technology and cryptocurrency, they're assets that often weather financial storms well. Even with a modest investment, you can participate in this market. These assets have the potential to outperform traditional investments during uncertain times. So, in the middle of financial uncertainty, remember that strategic asset positioning, particularly in assets like Bitcoin and technology, can play a pivotal role in securing your financial future. If you're keeping up with us so far, make sure to like and subscribe to the channel for more videos like these. Now, let's take this one step further. Metcalfes Law helps us figure out how popular a cryptocurrency is. It looks at two things: how many people are using it and how much activity is happening on that cryptocurrency network. When we multiply these two numbers, we get a big number that matches the cryptocurrency's price on a graph. Which is kind of like magic because price isn't directly in the equation. Now, let's talk about productivity. People love technology because it makes life easier. It helps us work better and solve everyday problems. Technology is teaming up with the Green Revolution to fight climate change. Smart technologies like AI and machines are like superheroes saving our planet. And think about oil prices, which have been stuck for a long time. With these technological advancements and increased productivity, Metcalfes Law measures popularity, and productivity is the superhero boosting our economies. When those two things come together, it changes our world for the better. Why didn't the internet, seemingly a miracle for productivity, revolutionize everything? Well, it did create and displace jobs, but the grand picture is that technology's growth alone can't fully counterbalance demographic shifts and global trends. What's missing is a catalyst, something to supercharge productivity, and that's where we're headed. You might ponder why a shrinking population isn't necessarily a bad thing. In fact, it can lead to a higher per capita GDP, meaning more prosperity for each person. But there's a crucial caveat. We must ensure that this wealth isn't hoarded by a few megacorporations. This is where taxation and wealth redistribution become vital. But what if the population shrinks, yet productivity remains stagnant? That's when we find ourselves trapped in a cycle of sluggish economic growth, far from ideal. Now let's dive into the intriguing topic of China's about-face on Bitcoin. They've cracked down on it multiple times, including in Hong Kong, which caught everyone off guard. But this isn't their first rodeo. They clamp down when they want to control capital flight, especially when the US dollar is strong and they can't risk losing control of their currency. Plus, they're making strides with their central bank digital currency. It allows them to keep tabs on the yuan in circulation, something they couldn't do easily before. It's like blockchain's transparency flipped the privacy script, and China's moves are all about staying ahead in the financial game. You know, what's more intriguing is that finance managed to weather all storms because the Chinese government was keen on its survival. It serves as a vital link between the traditional financial world and the crypto realm. Surprisingly, the Chinese state actively supports the world's largest crypto exchange, recognizing it as a potential bet on the future of financial systems. It actually makes sense. Think about it. Binance, one of the major players, doesn't even have a headquarters. It's based in Dubai, of all places. Now, let's shift our gaze back to the US. In all likelihood, the US will throw the weight behind Coinbase eventually. Why? Because maintaining control over the situation is paramount. If they don't, the UK might swoop in and dominate the emerging world of new money. The key here is that such a significant change can't happen abruptly. It needs to be a gradual process. Cryptocurrencies can slowly mature and be fine-tuned to take over the role of traditional finance. So, the US government's approach to regulation seems more about slowing down this transition than outright banning crypto. They want to make sure they can collect taxes because if everyone starts living in the crypto world, they need a way to pay the bills. The UK and Europe are likely to follow suit, introducing central bank digital currencies to regain control of the financial system. As for the banking crisis, we might be in the summer phase, where things seem bad but are relatively stable. However, deposits keep flowing out of the traditional banking system. To fix this, interest rates need to go back to near zero levels. We'll see the signs when it gets worse, such as regional banks' ETF prices going down. Eventually, one of the major banks might collapse or be forced into a merger. That's when the Federal Reserve will step in with their magic money to prevent a full-blown reset. Let's revisit the topic of central bank digital currencies. Rather than fixating solely on CBDCs, we must broaden our perspective to consider the overarching issue of government control. While CBDCs offer advantages like swift crisis relief, efficient economic stimulus, and incentives for economic responsibility, they also carry the risk of government abuse of power, particularly concerning privacy concerns in our increasing transparent world. We shouldn't get too enthusiastic about CBDCs. They present opportunities for economic enhancement, but the genuine threat lies in potential governmental misapplication of authority, demanding our vigilant monitoring. The goal is then to shift to Web3 and the financialization of everything. The 1980s saw a surge driven by low interest rates and the end of inflation. Web3 holds the potential to democratize access to capital. However, it may also fuel speculative bubbles, scams, and questionable ventures. The key question is whether participants will become more discerning. Striking the right balance between regulation and freedom is crucial. Regulations should focus on clear rules, fraud prevention, and enforceable contracts rather than stifling innovation. Web3 could revolutionize capital access, but responsible engagement is vital to avoid reckless speculation and abuse. And if you learned something new in this video, make sure to like and subscribe to the channel for the latest finance and investment updates.